Friday, July 26th. Next week is earthquake prone, and unlike scientists in California and Japan, we know exactly when they can happen. We just don't know the magnitude. On Wednesday, the Fed will complete its July meeting. It will cut the overnight cost of money by 0.25%. That event is entirely built into current mortgage rates. There will be no improvement on Wednesday from the rate cut itself. What the Fed chair says at his press conference afterwards about future cuts may have big effect. Built into the financial markets are not just the cut next week, but two more. And whether they're going to take place or not is a matter of some tectonic uncertainty. And then on Friday, just to keep everybody on edge, at dawn, Colorado time, 6:30 in the morning, will come the report of job creation during the month of July in the United States. And it's the most important data that comes out every month as a barometer of the U.S. economy, the potential for inflation or not. And as important as the number is, and exact as it sounds, it's a wild estimate every week. Every month. Now, the U.S. economy data that appeared this week continues a pattern of perfectly solid strength. Second quarter GDP grew 2.1%, reduced by some factors that appeared that weren't in the first quarter. Consumer spending in the second quarter in the U.S. was over 4%. That's rocking. It was supported by government spending up 5%, which is not sustainable, but never mind. The economy's just fine. The new housing stats that came out, sales of existing homes, sales of new homes, are flat. There's no particular change from last year. But the problem is not demand, the problem is supply. All across the U.S., in the markets most in demand, there isn't any land to put new houses on. We're in a process nationwide of both adjusting buyer acceptance to living in attached homes and rezoning land in and near single-family neighborhoods to produce sites to build attached housing. And that's a slow-motion affair. That kind of rezoning is a political battle every time somebody tries, but the flat state of home sales is not an indication of weakness or distress in any way. So why is the Fed going to cut rates? Why are rates down as far as they are? It's all overseas. The newest data this week was from Europe, and it's awful. The same kinds of surveys that we do here, the Europeans do, and Germany's manufacturing is suddenly deep in recession. It's in a serious contraction. The European Central Bank on Wednesday announced that it will embark on new stimulus, or perhaps better said, it will re-embark on old stimulus. And rates improved here on that news, and then thought about it for a minute, then no. The market response to the European Central Bank announcement was to buy the assets which the European Central Bank will buy to provide stimulus. Nobody took any new risk. The market judgment on the stimulus that's going to come in Europe is that it's nice, but it won't do any good. The U.S. easing by the Fed and reduction in interest rates is entirely a kind of insurance policy against distress overseas washing up on our shores like a dead whale. We've tried this before. 1998, we were in a similar situation. Later, we wished that we had not eased. I don't think anybody alive knows how this one's going to turn out. The tilt, the longer we stay as low as we are, without any kind of correction or retracement back upwards, tilts the table towards further declines. But those odds, it's all in 50-50. But Wednesday, after lunchtime, first thing Friday morning, a good idea to lay the wine bottles down on their sides, put the rest of the crockery on the floor, and you might stay outside, go for a walk while the news appears. Have a good weekend.